Okay, I'm going to get into phase 3 in this video. I already covered 1 and 2, and I'll make a phase 4 after this video here in a few days. But I highly suggest you watch all 4 because each phase has a purpose, and then there's some tools in each phase you can use for other phases as well. So I'm going to talk about phase 3, and then I'm going to talk about phase 3 with a bridge, and I'll explain what the bridge is. And I'm going to explain what we hold in our portfolio and why, and what we do in our portfolio to protect this in phase 3. And different ideas that you can do instead if you want to, because phase 3 is about protecting our time, because at this point your portfolio is big enough to where we're walking into real financial freedom, and a bad sequence of events like the lost decades, some bad bear markets will take years to recover, if at all, depending on what you're investing in. And this is all about protecting that capital without slowing down growth. That's the key. It's not about me allocating in different things to slow down our growth. Actually, we're beating the market while we're in phase 3. So it's amazing. But you got to have a big enough portfolio to do the work for you, and that's the whole idea behind phase 3. In the last video, I showed the tool, the Financial Freedom Calculator, and showed you how to use that tool and to see when your portfolio is sizable enough to be considered for phase 3. But again, there's some tools in here that you can use, and you don't have to be in phase 3, but you have to make that decision yourself. So let's walk through them and you see what they are. Okay, if you've read my lectures, and you would understand what the sequence of events is, you would understand what time risk versus volatility risk is, and you'll understand what a bear market is, and so forth. But if you haven't, you probably don't understand what a time risk and volatility risk is. But however, you probably understand what a bear market is if you're into buying assets or the stock market. However, here's the thing. A lot of people now in 2026 that I've heard talk, or my son or my kids have talked to people, and they always hear these things either from their own experiences or older people that's been through the 2008 crash. So a lot of times people will yell, I'm not buying the stock market, it's gambling because I'm not going to get caught up because I know somebody lost all their money in 2008 and all this stuff. One, the market did not go down to zero, so they didn't lose all their money. Two, if you sold, you locked in, you realized losses. And three, and if you had a money manager or didn't manage your money right, you're probably taking withdrawals out into retirement and following a whole bear market. So I'll come up with a solution for this, and that's what I do. I don't get caught up in bear markets. It's pretty much impossible with my system, and I'll share that here later. But I want to bring this to you because here's the problem. In phase 3 and then phase 4, but in phase 3, your capital is large enough now that these things, like from 2000, the dot-com bubble, this is the SP 500 chart. But anyway, from 2000 through 2013, this is what they call a lost decade. Now, I don't know the future, neither do you, and neither does anybody else. But to say this won't happen again is kind of ludicrous because it happened from 1965 to 1980, and then in 1929 we had the Great Depression. I'm not saying we're going to go through the Great Depression or stagflation or a recession, but what I'm saying is throughout history, with economics and everything else, everything fluctuates. So we will go through times of bear markets. That's pretty much guaranteed. But when you're in phase 2, this is irrelevant and actually a great thing for dollar cost averaging. But when you're in phase 3, this is not a great thing because it could take our retirement plans and throw them off by several years. And if you're in retirement and you're pulling your money out, you're pulling down at some significant losses depending on what you're allocated in. I'm going to share that in a second too. So anyway, my point being is I'm going to show you a way to avoid that. I avoid this and prevent this from causing damage. And you'll see other years, like I just said, here is the 1965 through 1980, same thing, chop, chop, chop. Now, again, I hate it when people say the market usually goes up more than down and we have more gaining years. Well, first off, I don't live January to December. I buy groceries in the middle of July too on a rolling time frame. And so will anybody in retirement. Everything's on a rolling time frame, not January, December, because it depends on what the market does from July to July as well, not just January, December. And it recovers. That's wonderful for smaller portfolios that's building up, and you're building your portfolio through a 401k or a dollar cost averaging. This is wonderful. It goes back up, it recovers. It's great. But if we're in early retirement or retirement period, and you're pulling money out of your portfolio either through dividends or withdrawals, it doesn't really matter, then these things will matter, okay? So let's avoid those if possible, and I'll show you ways that people tell you to do it, which to me will not work now in 2026. This is not 1980 through 2020 anymore. You need to realize what environment you're in real time, which is hard to do sometimes. But you got to understand and do a little bit of research, or I'll share my thoughts, and then you can look into these and see if you like that or not. And I'll show you why these things don't work anymore. I hit on this a little bit in the phase 2 video. I will not hit on it as longer in this video. I'll hit on it real quick. But the reason a lot of these people out here talk about as you get older or closer to retirement, start taking your portfolio and like these target date funds, or start buying more bonds and less equities, less stocks, and try to shift your portfolio from 100% equities and shift it over to whatever, whether it's 30, 70, or 60, 50, 50, whatever, and shift it as you get closer. I personally don't like that. And I'll tell you why I don't like it, and then you can agree or disagree, that's fine, but I'm going to show you why I don't like it. One, this is 1980. This is the 10-year treasury. This is kind of like a measuring stick here. This is bonds. One, they say buy bonds. Well, that's like me saying, hey, go buy a vehicle. You know, there's a lot of types of vehicles, a lot of manufacturers things. Same way with bonds. Bonds are just like stocks. There's a lot types of bonds and maturity dates and exposure. So to say go buy bonds is a generic advice that people need to give more detail in. All right, so this is 1980, and this is right after COVID in 2020 era. Well, the bond yields have been going down. So bond yields is kind of like a dividend yield. When the bond prices go up, the bond yields go down, and vice versa. Well, then the Federal Reserve and central banks, whatever, they made decisions to raise rates to try to tame inflation problems after COVID in 2022, and now we've been sideways again. This is June 16, 2026. We got a new Fed chair coming in to talk later this week. We'll see how that goes. But either way, it's about the direction of the bond yields. Okay, that's my point. Is we're not in this fantasy anymore. The bond yields still can go down. Obviously, they can still cut yield rates and go down. But here we are, almost a zero right here in 2020. 1980, we were up here. I'll move my head out of the way. We're up here around 15. Okay, so 15 down to 0. Then back up to close to 5. And right now we're around 4.4 to 4.5 in a 10-year. So it tells you from 4.4, 4.5 down to 0, it's still down. I mean, on a percentage basis, I get that. But what I'm saying is the wiggle room from 4.5 down to 0 versus 15 down to 0 is a whole different ballgame. So we could be in a lower rate environment. That is very, very possible. I get all that. But my point being is you got to be aware of this depending on what kind of bonds you buy. That is what I'm saying. Here is one ETF. There's a bunch of ETFs with bonds and bond blends and stuff like this. But here's one that's 30% in equity and almost 70% in fixed income and cash derivatives. So it is a 30/70 conservative allocation ETF. A-OK. It's through iShares. I'm sharing this with you because the old school cookie cutter advice is start getting more into bonds as you get older. I hate that advice. Why? Because if bonds grow slower, then when my portfolio is getting bigger, when I have more money to make money, it's a huge difference. Okay, let me explain. If you have a $10,000 portfolio versus a $500,000 portfolio versus a $1 million portfolio, yes, a percentage is a percentage. I get it. If you get a 10% return, it's 10%. But 10% on $1 million and 10% on $10,000 is a whole different ballgame. It's life changing. And then if you get caught up in the bear markets, then it's really life changing because the money you can add in there if you're still working is going to be insignificant compared to the size of that portfolio. And you can get caught up in several years of putting your retirement on hold or being in retirement and forced back into the workforce. So with people preaching buy more bonds and don't tell you what bonds, and if they do, if they say something like this, they have different ones. But if you're into these kind of things exposed, I'm going to show you what they do. Because again, this is not 1980 to 2020 anymore. We're in a low yield environment. So yeah, they can still cut rates. Again, I'm getting on that. But when they raise rates, if inflation gets high and they raise rates like 2022, These get destroyed just as much if you was fully allocated in, say, the SP 500 through an ETF like VOO. You can ride the same wave because of the rate hikes. Okay, here is that ETF AOK with the mostly bonds. And here is October 21, and this is 22 when the Federal Reserve started raising rates, and then to offset inflation, or attempt to. And it rode the wave down. Now, I'm not against pullbacks and drawdowns, because you'll see what I do later has some huge drawdowns. But what I have a problem with is the drawdowns don't have enough upside to make up for the drawdowns you take, and you're staying the whole time. These are all drawdowns. So let's overlay the SP 500, and I'm going to show you something. Okay, this blue line is the SP 500, and those little candles right there are weekly candles, and that's AOK, the ticker symbol AOK, the mostly bonds. You can see since the inception date that the SP 500 is beating it significantly. But that's not what phase 3 is about. Phase 3 is about when you have a large portfolio, protecting your portfolio. It's not about the growth. That's a phase 2 thing. Growth is important in phase 3 and phase 4, but not in the same sense as phase 2. So anyway, what I want to show is withdrawals or whatever time frame. So let's look at when the Federal Reserve started raising rates to beat inflation, and then the bond ETF, how it acted in comparison to 100% equity versus a 30% equity fund. Okay, so here's the blue line again. January 2022 was SP 500, 100% equities. The candles, the red green candles, was the 30% equities, 70% bonds. You see it went down the same rabbit hole that the market did. But then the SP 500 equities recovered, and this did not recover, and you would still be taking withdrawals out at a lower portfolio even to today if someone was in this thinking it was safe to prevent them from sequence of events. It's because you need to know the environment you're in the best you can. And looking at the 10-year bonds helps with that, and seeing what the Fed funds do. But I spoke on that on phase 2. And again, that's the problem, that I don't buy things like this. I buy bonds, and I'll share what I bought for the purpose I bought it. But I don't buy cookie cutter ETFs with long dated far out bonds to try to get growth. That's what they're trying to do, get growth with bond as well. I use something different for growth in these bonds for protection for income and to keep the downside risk out of play. Here is another ETF. It does something different. These are buffer ETFs, and you can research buffer ETFs, and I spoke with them in my lectures. This one, ticker symbol is PTLC, and on the website they tell you what they do, and the way they allocate things. They've got a video on here as well, and all kind of information. And what they do is when the SP 500 hits certain levels, then they'll switch to 50-50 with 50% 3-month U.S. Treasury bills. I like this a lot better in the sense that they use short-term U.S. bonds, because the short terms, they don't move as bad in a rate hike environment or anything like that, and they're a little stable, more stable. And then they'll adjust to 100% if they need to, based on this criteria. And I'm gonna explain why I don't use this either, even though I like this better than the last AOK style. I'd much rather do this to try to protect my capital, but I'm going to show you a weakness with this and why I don't use it. But I use something pretty similar that's rule-based that gets me out as well, but then when I get in, I'm not lagging the overall market. Here's the chart of PTLC, that Pacer Trend Pilot ETF that is rule-based, and it gets out of equities and into short-term bonds. And here's what it did during the 2022. So it was exposed, and then it got out into bonds, and it got back in, and then it had in 2025, it had a signal, got out, and then back. And here's the thing. You'll hear buy the dip mentality a lot out there. And people will cult follow people that say buy the dip all the time. I'm not here to talk trash, but what I'm here to say is mathematically about 85, 86% of the time, the market does do drawdowns and pulls right back up to rally. It's not what I'm worried about. What I'm worried about is when I got a large portfolio, it's those 1%, 10%, or 15% of the times when it doesn't recover right away, and it takes me several years to get back to where I was at and throw me off on my retirement income. That is the problem. So it's not that I'm scared to buy a dip. It's a whole different ballgame from phase 2. Small portfolios can do that, but when we get to larger portfolios, we need to be more aware of real risk, and that is time. All right, so I'm going to show you why I don't use this, even though I think it's better than the AOK. But here's why I don't use this. Okay, this is lined up again with SP 500 with the blue line. Now, the inception date on this fund is June of 2015. But over time, you can see the damage of getting out of the market, because you will hear a lot of people that understand money that it's best to, in some cases, let me explain. In most cases, it's better to have time in the market than time in the market. That's a famous saying out there. That is true, but it's not. But it's true in certain things. That is true in a phase 2 thing. But to me, I break everything down in phases for a simple reason. You tell people that it's better to stay time in the market than time in the market that lived through retirement in 2000 through 2013, or who lived in retirement in 1929 through the Great Depression, or people who lived in the 1965 to 1980 stagflation. If they did not have a rule-based system or something better so their cash is accessible to them so they can allocate it to those high yields that was given out in 1980 to other things, and their money wasn't tied up in a bear market, it's a whole different ballgame. If people were 1929 through 1930 fully invested and decided to stay time in the market versus time in the market and stayed there for that big drawdown when we went through a deflationary period, if they were in cash, their money would have been getting stronger, their cash would have get stronger value with deflation, and had capital to live on and capital to allocate when something else presents itself. If people were in 2000 to 2003 or 2007 through 2009 and went through that crash, if they had a trend following system and they had cash in their hand, they could allocate it to other assets when those opportunities came to them. Especially in 2008, 2009, you could have real estate. I mean, I'm not being hindsight here, so you'll see what I'm saying with my trend system. But here is a trend system with an ETF. You just buy it, set it, forget it, and it does the work for you. But here lies the weakness. The weakness is over time, the overall market outperformed it because it kept getting out and back in later. Because like I said, about 85% or so, rough estimate, the dips, depending how far back in history you go, it recovers and goes back up and you have to buy in at a higher price. So it starts to have a tendency to lag over time. Because what it's getting in is basically the same thing. So it's a 1-to-1. So it's trying to get this same rally, but it got out and had to get back in, got out, had to get back in, and then it's starting to, that's basically like paying insurance for that protection, I guess, which I have no problem with. But I have a better way to make this and this and this move significantly faster to outpace this to make up for that insurance you paid to step aside. But if you come back to the 2022 and line it up, right here in 2021, line these up. You see it did its job pretty good. And you know, nobody knows the future how quick this would take. It could have been a 2000, 2003 thing way down here, but it didn't. It recovered relatively well. But this ETF did its job. It did what it's designed to do. It got back out. It stayed here and didn't go all the way down. So if someone was taking withdrawals out of here, they would not be pulling money out at the lows. They would be about halfway down and they're right over. And it's done pretty well. But it's starting to get left behind from being pulled out here and then back in. And this is only a few years. So over a 30-year retirement, this is going to be significant. Like I showed you from 2016 now, with it only in that time frame, within 10 years. So this can be getting big over 10, 20, 30 years. And that's when I like to look at things within 10-year periods. So again, I like this for like a set it and forget it type thing if you had a lot of capital and didn't want to get caught up in any future bear markets, because there will be future bear markets. I mean, I don't know the future, but 100 years of data says there's always bear markets every so many years. It's just who knows how deep they go and how long they last. That's the thing, we don't know. All right, let's look back at the S&P 500, and during the lost decade, the most recent lost decade we have was 2000 through 2013 time frame. We did go through a crash in 2022, which I can share that as well. But this is a monthly candle in S&P 500. This is the year 2000 through 2003, went back up, 2007 went down to March 2009, and came back up. And to get back up to the highs of this portfolio, you're looking around mid of 2013. Now, again, dollar cost average in phase 2, different ball game, small portfolio. Big portfolio, phase 3 and up. Then if you were taking and planning in phase 3, you and the wife, or you by yourself, or you and your husband, whatever, you were planning on saying, look, our portfolio is big enough that I think we can handle retiring early and go on travel or go see family, whatever strikes you, whatever you want to do. But either way, you have plans. You're coming up here through 1995, 97. This is really could happen. And this really could happen in 2026 is why I'm doing what I'm doing now with our portfolio, because I'm ready to go do things without having to rush back to a time clock. So anyway, you get up here and you get into your goals, and then you're like a couple months away from walking away from your job, retiring, going into, you know, whether it be you're older, getting in Social Security and the insurance through Medicare or what have you, or you're earlier and you say, I want financial freedom to start my own business, move, whatever. And then you had it in a passive, or just had an ETF, and you ride in the market with no trend following system, and you took this big downturn in your portfolio, and then now your portfolio shrunk a lot. And then your things started to change. If you were lucky, you were still working at the time, and when that happened, and you could just hopefully not panic and understand how this works, and you can just wait to recover to do something a little different. But either way, that's going to set you back years. And again, we can't get time back. We can make more money, but we can't make more time. Now, if you would have walked into retirement and didn't understand how sequence of events works, don't understand how the bond market works, don't understand trend following systems, and just let somebody manage your money, which is nothing, I'm not knocking it. And then walk into retirement, and then next thing you know, the first couple of years, some people will say leave it in the cash bucket. Well, that's lost opportunities, okay? And inflation's eating at that depending on what it's in. So anyway, even though we got a big cash bucket right at the moment, but I'll explain why. And I'm not a fan of cash buckets, and I'll explain why that as well. But anyway, you walk in here in your retirement, this is like terrible. And you're like, oh, that's only happened once in a lifetime. No, it doesn't. This happened through 1965 through 1980. It happened in 2022. It happened through 2013. We are in a strong bull market, and we've been in it for several years. So when it ends, then I don't want to be knowing somebody who walks into retirement without understanding these things, get caught up in destroying their emotionally or their relationship or stress or mental health with this. I really don't. So I'm just sharing what I'm doing and what I figured out and what I'm doing. I'm not here to make people do what I do, but I really want to help and show people, because people get destroyed with this all the time. Here's 2021 to 2022. It looks like nothing on paper on a monthly candle. Oh, that was nothing. Well, tell that to somebody who's 65 years old or 60 years old, walked into retirement, and their portfolio is here and it dropped down 20, 30%, and they don't know that it's going to go back up, and they're having to pull money out, and you have to wait from December 2021 to December 2023 to be back to break even, not to mention all the money you pulled out here, so you're not to break even again. You haven't even started making a profit yet again. So here, and then as soon as you get feeling good, here we go, this craziness in 2025. I'm just saying, it pulled all the way back down to here. So these things are important, and why I treat our portfolio different than I would have several years ago. And that's what I'm going to show you of how to avoid these things. Now, this is something that I'm not going to cover exactly how to do it, because I have a video on our page, and I believe I have one on the public YouTube explaining this as well. But here is a tool that I made very similar to that ETF PTLC. It's very similar to the rules of getting out and getting in. However, I make it a channel to avoid a lot of unnecessary whipsaws, because whipsaws in a taxable account will cause wash sales But again, I spoke with that, I believe, in my lectures. And my point being is, this is my system to, if you will, time the market. But I try to stay in as an investor as long as possible until the market tells me otherwise. And so, again, 2022, it kept me out of this bear market. 2025, sharp V bottom, it would have got me out. That is the channel. The red and green line is a channel. The background color, you can make it darker or lighter with this tool, but again, I'm not walking through how to do the settings in this tool here. But they're red, yellow, and green, and they show the strength of the, basically the regime or the strength of the market and trend. Red is bad, obviously. Yellow is cautionary. Green is shows good. And this is a monthly candle, so a daily, weekly candle, or 1 minute it could be used on. But the higher time frames, a lot better returns for risk reward. So anyway, if I would have got out here on the red and got back into green, I just gave up a big gap cost of insurance and got in later. And then obviously I would have underperformed the market if I was buying, say, VOO or something like that and doing a one-to-one match. But that's not what I do. I make up the ground, and I'll show you how to do that, or how I do that. So yes, a lot of times there is V bottoms. And then again, this is what I was concerned with. So in instance, got out with COVID, you get back in, you make these gains, you get out and make these gains again. Instead of staying in and getting back up here, you got extra money because you got back in here and here. So it's a little bit difference. A lot bigger difference than what I'm about to show you. And this works. The red would have kept me out of this chop in 2015. And I gotta take these, I got signals for reverse trends, but I'll take that off. So here is the lost decade. Now think about this. Again, you're not in phase 2. This is not phase 2, it's phase 3. You had your money. I get out because the signal says get out. Didn't notice what will happen. But then when I get back in, you can make these gains or some gains all the way back up here, whereas you just be waiting for years and years and years, over a decade, to get back to break even. Whereas I have opportunity to make profits along the way. This works. The 1975-65 was the nastiest time in history when I checked this kind of stuff, but it still worked. And it did the same thing, kept me out. What about the Great Depression? Yep. Got out October 29, didn't say get back in until August 32, but it still made a nasty loss here, and then got back in. It was choppy, it was rough, but we would have saved a lot of money. Now understand, I am very aware that the market in the environment we're in 2026 is a lot different than 1929. However, I know human psychology is going to be the same regardless of when we're at. Here's some stuff going through the 1950s, getting a ride up, taking some chop, getting a ride up, taking another ride up, getting out, taking another ride up. The idea behind my system is to stay in as long as possible. And then when you get in phase 4, I'll explain to you how I can use this for withdrawals to make income. Here's the NASDAQ 100, and if you watch the media, or probably even YouTube or anything on TV about the stock market, you will hear, one day you'll hear everybody scared and preaching fear, and the next week they'll be preaching greed and bubbles and all kind of stuff just to make entertainment. So here's the dot-com bubble, and this trend system works the same. It would have got you out here in 2000 and got back in 2003. And in the meantime, this cash is not there just sitting there wasted. You can put it in what I'm about to show you that I have our money in, and or high yield savings accounts, whatever is out there in the environment. You got to look at the yield rates and see what's the opportunity. There's always money to be made in the market. It's just in different places. So this time I bring up opportunities to put other things to work. So if you're taking withdrawals off of there, it's not like you're taking and have all the money in a checking account that's giving you no return, and you're pulling all your money out of there and inflation's eating it away. You always, at least I do, put our cash, our capital allocated somewhere that's giving me some kind of return to at least meet or beat inflation, so I'm not killing us and letting inflation take advantage of our cash. The only cash we ever have in a checking account that has really no returns at all is maybe for a month or two of expenses. Other than that, all my capital is being worked somewhere else. I cannot promise any future returns, but what I use for our portfolio that we are going to have, well, what we did in phase 3 to get to the point to where I'm at right now. It's been several years I've been trying to figure out how to use these 3 times leverage ETFs, because when I first got into learning about leverage ETFs, there is so much I don't want to say that. There is so much misinformation, I guess that's the nicest way to say it, about leverage ETFs. And I put articles, some great articles, there's 2 of them, in the lectures that speak on these leverage ETFs behavior, the math, and they back test it and do it against things like that. And I also did my own type of back testing using SP and the NASDAQ with my transfer tax strategy, this right here, this PCFC Trend Rider plus TAS system that I put together, and it's wonderful. And when you use a 3 times leverage ETF, which I would not do in a phase 2, but in a phase 3 I do, because when you're out of the market and you're not time in the market to, like I showed you with PTLC ETF, to catch back up, you're left in the dust. So with this, you get huge moves, and I'm not going to guarantee all the moves. I mean, this peaked up here at almost 300%, but then it got out around 168. Actually, with my rules, it would have been more like 151. I'll put them up here right here, the actual returns. So my point being, there is some drawdowns, but if you get in and use my rules with the stop loss in the channel, which I went over, and I got tools for that, and you don't get in when it's red, and I wait for the end of the month and do all those things, I get big returns. And it's not for everybody. If you don't understand volatility, you don't understand a rule-based system, and you can't keep your emotions in check, then it's not going to be for everyone. But it is huge. You get up huge, and then in the last couple of years, it's really took my retirement goals and sped them up drastically to where I'm excited, super excited. And when I do stuff like this, I don't have to get into the camp of like, oh, you're retiring early, so you need a whole lot more money than somebody with a 4% rule. I am not one to do things recklessly. I look at the math, and I look at history, and I look at the best case, worst case, and I don't see that nonsense, because what I'm going to do, I'll explain in phase 4 what I'm talking about some more on that. On our website, one of many tools in there, and more coming in the future, I have a phase 4 readiness calculator. If anybody wants to use it, I explain how to use it here on the website, and I'll show you in a minute how to get all this stuff. And on here, you can put in your income rates. You can customize it whatever you want. Conservative, the normal stuff that people preach, traditional, and if fire people out there that want to financially independent, retire early, they want to preach even a more conservative, huge portfolio. Again, not knocking it, do whatever you're comfortable with. Me, honestly, I will talk in phase 4 more on this, but a 6% structured income blend, and I look through history, I don't see how you cannot get 6% income from a portfolio, and that portfolio never run out of money. But this is a tool, you put in that, you put in if you get a pension or Social Security coming up. Now remember, I will say this real quick, and then you put in your numbers, and it will show you down here based on your budget, if your income rate, whatever you decide, this is their target. This right here is your target for phase 4. Now, when you put in your Social Security and you put in your, if you have a pension, or if you have like anything from the military, veterans, whatever income, then you put in that information, and the portfolio has to pick up the difference, and it will show you what it needs to do to pick up the difference. But when you talk about Social Security, I mentioned this in the lectures and on the tools. If you're a married couple, you have to be aware, if you take you and your spouse's income and you plan on living on that income, be aware that when one of you pass away, you're going to lose the lower amount of income. So if you have one person with $1,900 a month, one person with $2,300 a month, one of you pass away, the other one can take the higher of the two, but they don't get to keep both of those Social Securities, okay? So if you want to, you can stagger out the income to you take one of y'all's first. I don't blame you for taking the money. I don't. But take the money first and then wait. If you can live on that one with your portfolio, you can leave the other one for later in life to take it. So when one of your spouses passes away, the other spouse gets the higher income because you let it wait in Social Security. That's one option. And another option is if both of you can manage a portfolio and you don't have to worry about, like me, if I was to die today, Marcy's really good with money, but she doesn't really understand or do my tax system. So I need to be aware of that. And she needs to learn that over the next couple of years, how to manage a portfolio the way I manage a portfolio. Because if both parties can emotionally handle and manage a portfolio without, this is easy to do. You don't have to be a day trader. But I'd make it easy. So anyway, if both parties can manage a portfolio, emotionally can handle it, then you can take Social Security as soon as you can get it for both parties and go ahead and do that. The reason I say that is because I'm going through the same scenario with math on a pension and Social Security. If I can draw my pension earlier, I'm going to take it, even though it would be bigger to wait 10 years later when I'm 65 than take it at 55 when I get there. Because the math says the money that I can get from my pension or Social Security works the same, then that's money that I don't have to take away from my portfolio. My compounded annual growth rate in my portfolio is larger than the difference of my pension would be or the Social Security would be years later. So if I can take that pension or Social Security away from and cushion my portfolio has to work, that money that would be over the difference of those years is that money compounding and going to be more money later than it would be putting off Social Security pension. That's a nutshell of what I'm saying. Here's a tool that I've used several times for my wife and I put it on here as well on the website. It's a retirement runway bridge planner. And again, when I use that word retirement, I know people that's younger than me or even my age probably are like, retirement? I'm not worried about retirement until you're 65 or 62 or whatever. That's going to be a mistake. So if you're in your 20s or 30s or 40s or 50s, whatever, I highly suggest you using this regardless. And kind of get an idea. Because like, if everything works out, I don't say I can't, unless something really tragic happens, but walking into retirement, early retirement, 51 years old here soon. And you can do that, but you got to be aware of sequence of events like I talked about with the charts of what happens. But I'm not going to put in numbers here because I'm not going to put in my personal information for my wife and I here. But you go here and it's self-explanatory, and if people request me to do a detailed video on how to, run some fake numbers, I can. But you put in your stuff, single, couple, whatever, your date, you type in the date, and there's the calendar's black here, but all you gotta do is put in this date and type in a number like 7 for July, and it will turn to July. Same thing here. You put the balances as of month, you stop work, like if you got a goal to stop, like me, at the end of December 2026, I'm officially retired. Other than helping people out, I'm not making money to live on PCFC. That's hasn't happened yet. When it does, I'm gonna invest it back into anyway. That's the other goals. And then the currency, you can change the currency because I want this to be international. And then your number format code, and then projection in age. You can put 100 or whatever age. I put 100 because my mother-in-law will be 99 this year, and she's still getting around. So if my wife lives to be as fortunate like her mom, then we need to plan a long ways out. You can put the person's name here, the date of birth, then your spending targets, and your inflation assumptions, and then your healthcare budget if you want to, and then estimated taxes on withdrawals. You can keep it simple or flat, whatever. And then your start following it down here and filling out these things and take your time, and then put in your accounts And what this thing will do is it will run your numbers. You put in your Social Security start month, optional or person 2, whenever you want to do this, and you can play with this and your amounts of Social Security. Go on socialsecurity.gov or Social Security website to see what your Social Security will be at the time with the stop dates, so you know what to put here. And then you run your numbers, and when you run your plan, I'll pop up a little picture here. It will show you a graph, and then you can download it or whatever, and it will show you each one of your accounts color coded and how it will play out based on your compound annual growth rate. Again, I stress all the time, compound annual growth rate is a smooth average compound annual growth rate. So it could be up 20% one year, it could be down 30% one year. TQQQ could be up 100% one year, it could be down 73% in 1 year, depending on how you use your system. So remember that sequence of events. So me and the wife, we do not need what we need. Our goal for our retirement annual income is not what we need to just live, like to pay our necessities. What we added in was traveling and having fun, enjoying our life, especially while we still got our health and can do our stuff. So we cushioned, I gave ourselves a cushion. Plus my wife, unlike me, when that trade school and college debate comes up, trade schools do make money and I make good money, but I cannot work remotely with my job. I can travel, be a contractor, but I'd have to show up somewhere. My wife's college education and her background, she can do a lot of stuff from the internet around the world, anywhere. So to offset our insurance, we'll take all that in consideration. I'm not putting that out here on public right now. Go to our home page, and you can, the free tools are here, and you can log on or sign up for free phase 1. And you can get a complete program right here, and there's even a discount for annual payment. But either way, when you go there and you log in, there you log in, and then if somebody forgot their password or whatever, the spam mail, you put in your email, forget the password, and then there'll be an email sent to you again to do this. You'll receive the courses, and if you have all the complete system, you'll have all 1 through 4, tons of information. And I'm always there with any, if you got any questions, you can contact us through here, and I'll do the best I can to answer. And if I can't, I'm not gonna lie to you, and then we'll research it together, because it's something I may need to learn myself. So go here to the quick access buttons, and then here's some navigation here to go back home to courses or whatever. There's always something at the top of your header somewhere or footer to get you around in this website. And then the to get to all these advanced stuff, the Advanced Strategy Tools Library, that will get you to your 401k, Financial Freedom Roadmap Calculator, Build a Portfolio with a Purpose, like I talked about, and different ideas. And then your Phase 4 Readiness Calculator I just showed, and your Retirement Bridge tool, which I love as well. And it's right here, and you can open it up, and it'll take you right there. Okay, for our personal portfolio, for our Phase 3 Bridge, for early retirement, I still have our IRAs and TQQQ riding my trend following system that I made, task, transfer, attack strategy. And that's going to be there because we have several years before we can access that. And our taxable accounts, our cash accounts, I divided it up into 4 different ETFs, which are short-term bond ETFs. PULS, JPST, ICSH, FLOT. I put those, I searched the screener on Fidelity for bond ETFs and stuff for fixed income, and of the ones I found, these are the ones I like the best for their behavior during a rate hike cycle and their current monthly payouts. Now I know that anything like this, their amounts they pay out is going to change, just like a high yield savings account will. So why did I do this versus a high yield savings account? A high yield savings account would be FDIC insured depending on the amount of money and how many people, on how many accounts, all that stuff. But with this, yes, it can move, obviously, the price of the ETF itself versus, say, a high yield savings account. But the reason I did that is because I wanted it liquid, still in my Fidelity account. So whenever, hopefully a long time from now, hopefully a year or so from now, but whatever, if the market does another unnecessary drawdown and it resets my TAS signal, my trend following signal, then I will evaluate it at that time and see about putting these funds back in there, this capital back in there. So I need it liquid, so I don't have to wait for transactions between a bank to my bank to Fidelity in those days, because usually I don't need to look at a chart but once a month. But when something happens and I want to do something, I don't want to be dealing with transfers. I want it to be there. And the yield I'm getting here is around the same I'm getting in a high yield savings account, so over 4%. So that is good. So the reason I'm not still holding that cash in TQQQ, because we didn't have far to go to hit the goal that we needed. And it took me a lot of debate back and forth with math. It's not really emotional because I have a system in place for some of our money. At this point, I need to split it up. Our portfolios, some are available for us to touch now, our taxable accounts, and some, whether it be 401k rollovers, or IRAs, we cannot touch without penalty for several more years. So in that basket, or those funds, I keep in that TQQQ the cash that I'm going to need access to starting probably in about 6.5 months. Then we built that up with our extra cash flow from our incomes from our jobs, because we live below our means of what we make, and we added cash to our portfolio. Plus, TQQQ grew our capital in there, and the combination of those, it hit our target to fund us all the way up until our age for IRAs. But I'm not going to keep that sitting there like wasted money sitting there that's drawing a 4% yield. That's going to sit there until my transfer tax strategy shows me another solid entry in the future, and then I will reevaluate going back in for more growth, because it's not time for me to be super conservative and lose out on money, but at the same time I can't be real risky when my signal is way above my entry and taking a big drawdown possibility with anything in the market. So I got to treat that bridge, those accounts, differently than I do the other accounts, because I don't want to ruin our retirement dates. The conclusion for phase 3 is basically, it is important to protect a portfolio that you have built over the years, no matter if it's through a 401k or your own or both. It is important to start to protect that. But for me, the protection does not mean I'm going to reduce my growth. I want to grow it, but not get involved in a bad sequence of events with bear markets. That is the whole point. And then phase 4 can blend some of this stuff together. And then, of course, there's the bridge phase that I said, we want to, because a lot of people may get to retire earlier than they thought. But make sure you give yourself a cushion. Don't try to be like a very tight budget with this, just in case something happens bad. And always have an out. Always have like a cushion or whatever it may be in your life. Just know that. Don't try to get it down to a nickel and don't work out that way. All right, thank you. Have a good day.